Friday, January 5, the real world is back. Holidays are over. I am no longer Clark Griswold. Dang, I miss him this week every year. Markets are back and fully functioning. The economic data that came out today, and we got a long string of it this week from December, is actually a little stronger than it looks. The Fed will not forbear if the data looks the way that it looks. And the question for the whole year is going to be, as the Fed pushes up on short-term rates, how far do these guys go? And my hunch is that it's sort of this deal. I don't think long-term rates are going to move fast or far, but they're going up. We need to be alert to locking rates as soon as deals come together. But I have no alarm to spread. The stock market is in a state of exuberance, which is overdone, but everybody knows that. And at some point it's going to de-exuberance. But in the meantime, do watch the stock market because it will keep your mind off politics. The other elements out there that, as the copy near this video has at length, salesmen discovered a long time ago that if you can frighten potential clients, then they're easier to deal with. And so there's always this drumbeat with some guy in suspenders and a $300 necktie telling you what to be terrified about that only he or she sees, and come do business with me and I'll protect you and save you from this. So right after New Year predictions come New Year debunking, and there are two leading elements. One of them, there's this chatter about a weak dollar. No, it's not. And don't pay any attention to it anyway. Anybody who wants your attention to study the exchange rate of the dollar versus other currencies, just back quietly out of the room and try not to call that individual again. Reasons are, primary economy, ex-US, is China. China's yuan is pegged to the dollar. Neither one can strengthen or weaken relative to the other. The euro has gotten a little stronger just because Europe has pulled back from the potential disaster of the last half dozen years. There's nothing going on. The yen is the only other major currency in the world, and it is so rigged that it doesn't matter either. So if you got somebody in your ear about the dollar, it's the wrong guy. The second major effort to keep you frightened is the idea that the United States is drowning in debt. And some people who know better are trying to sell that one. This week, one of the great investment managers in the country began to talk about it. And if you take all of the numbers apart, as I did nearby, don't worry about this. The household debt is growing at a very reasonable pace. The sum of mortgages outstanding this year finally grew beyond their upward limit 10 years ago. The only two sectors of household debt that are growing are student loans and automobiles, and both are slowing down now because they have to. No big deal. Yes, the Treasury owes a lot of money. We know all about that stuff, and someday when rates go up, it'll cost us more to roll over our debt. But someday's not now, and there's no course of disaster nearby, despite the unfortunate tax bill. If you total up all of the assets in the country, the net worth of American households is just about $100 trillion. Total household debt is only $13 trillion. It's just, it's just not a lot of money. An amazing thing to say, but it's not relative to assets. The same thing is true for American businesses. The debt numbers that look so big, that are scary, include financial operations, meaning I own a bunch of treasuries or corporate bonds and I lever them, I borrow money against them. But post-bubble, there's nothing more regulated than that kind of debt. One of the key pieces that's most reassuring to me, I didn't know until last week, the following. Fannie and Freddie got into trouble in 2008 because they had kept retained as investments $1.7 trillion worth of mortgages and had financed them with short-term debt. They turned themselves into savings and loans. That aggregate retained portfolio has fallen by almost $1.5 trillion. They've gone from 1.7 trillion to 400 billion, very quietly, and over really not even the whole 10-year period, and without any effect on mortgage rates. All of that money is migrated back into private markets and out of their hands. The same thing is going on at the Fed in all of the bonds that it bought to get us out of our whole quantitative easing portfolio. It's bleeding off, and it's having no consequences to interest rates. There are things to worry about, always, but give it a rest. The U.S. economy is behaving very, very well. The only real hazard ahead of us right now is that it grows too fast. Happy New Year.